Hello everyone, let's talk about some correlations. So with this one, the core idea is oil moves first and the CAD often follows. The point of this presentation is to show you why that relationship matters and how you can use it as context when trading CAD pairs. Imagine crude oil drops 3%. A few minutes later, the Canadian dollar starts sliding too. That's not necessarily a coincidence. It is the kind of relationship traders can monitor between correlated markets. Here's the setup in this case. Crude oil moves lower, and then the Canadian dollar starts sliding as well. The important part is the timing. If you're only looking at the currency chart, you may think the CAD move appeared out of nowhere. But if you had oil on another screen, you would already have important context for what was happening. This is correlation. Canada is heavily connected to the energy market, so a meaningful move in crude oil can have implications for the Canadian dollar. Most retail traders tend to focus on one chart at a time, which means they can miss relationships like this entirely. The goal is not to treat correlation as a guarantee, it's a likelihood. It is to use it as another piece of information when you are assessing a trade. The economic logic starts with the physical side of the market. Canada is one of the world's largest oil exporters. When oil prices fall, the value of those exports can fall as well, which can put pressure on export revenue and the trade balance. Currency markets can price that changing economic picture very quickly, sometimes before the story becomes obvious in the headlines. That's why watching the underlying commodity can give you useful context for, in this case, Canadian dollar. This is the relationship traders need to remember. Crude oil and CAD often move in the same broad direction, while dollar CAD tends to move inversely to crude oil, right? Because the dollar is the first currency in the pair. So as a simple framework, oil up can support CAD strength, while oil down can coincide with CAD weakness. In dollar CAD, that can mean oil down and dollar CAD moving higher. Again, this is a tendency, not a mechanical rule. Other macro forces can overwhelm the relationship at any given time. This is where the timing becomes interesting. The sequence can look like this. Crude oil drops first, CAD starts sliding, and only later do news headlines explain or amplify the move. The gap is the alpha window, the brief period where the relationship between two correlated assets may give you information before the broader market narrative catches up. The key is to watch the markets together instead of waiting for the headline to tell you what already happened. If you're only watching your currency chart, you are seeing exactly half of the picture. Your chart tells you what CAD is doing. It does not automatically tell you what is driving the move. Putting crude oil beside your CAD chart gives you another source of information and lets you ask a much better question. Is the currency move being confirmed by the asset that is economically connected to it? This is the difference in perspective. The retail approach is often one isolated asset with lagging indicators and a reaction to the candle after it's already moved. The institutional approach is more interconnected. Desks can look at oil, CAD, and broader risk sentiment together, then pay attention to divergence between those markets. That does not mean institutions can predict every move. It means they are using more information to understand what is happening beneath the price action. The practical takeaway is simple. Correlated assets should be watched together. So CAD and oil should be watched together. The crude oil moves and CAD does not respond the way you would expect. That divergence is worth paying attention to. It can be an early clue that something else is driving the market or that a move may be developing. You do not need another indicator. You need one more chart open next to the one you are already watching. For CAD traders, that additional chart can be crude oil. If you want the exact correlation numbers behind this relationship, just go ahead and comment CAD in the comments below. In the next video, I'll break down the actual data and show you how strong the relationship has been over the relevant period. The main lesson here is simple. Stop looking at your currency pair in isolation. Add the correlated market. Watch how the two behave together and use that relationship as additional context for your trading decisions. All right, guys, trade well.